Ryan and Daniel are both 30 years old. They both live in Dallas. They both earn $75,000 a year. They both have $20,000 ready to invest, and they both commit to adding $800 every month for the next 20 years. Ryan spends his evenings studying companies. He reads earnings reports, watches interviews with CEOs, follows breaking market news, and believes that finding just a handful of winning stocks will let him retire early. Daniel does something much less exciting. He buys a low-cost S&P 500 index fund every month. No stock picks, no predictions, no late-night research sessions, just the same investment over and over again. Ask either one who made the smarter decision, and they'll both tell you it was them. Ryan thinks average investors settle for average returns. Daniel thinks trying to beat the market is a losing game. Here's the strange part. They're both missing something, because 20 years later, the difference between their outcomes won't be determined by intelligence. It won't even be determined by which stocks went up the most. It will be decided by a handful of tiny numbers almost nobody pays attention to. Trading costs, taxes, behavior, timing mistakes, and one statistic that quietly destroys more portfolios than almost anything else. By the end of this comparison, one of them will end up with dramatically more wealth than the other, but probably not for the reason you're expecting. To make this fair, both men start with exactly the same conditions. Same city, same salary, same age, same savings, same monthly contribution. The only difference is the strategy they choose. Because feelings and math are two very different things, Ryan opens a brokerage account and builds his own portfolio. He spreads his money across 12 companies. Some are technology stocks, some are healthcare, a few are dividend payers. He believes diversification matters, but not too much. After all, he wants the chance to outperform. Daniel chooses a single low-cost S&P 500 ETF with an annual expense ratio of just 0.03%. Every payday, £800 automatically goes into the fund. He never changes the amount. He never changes the investment. He doesn't even check the market most weeks. Immediately, Ryan feels like an investor. He can talk about earnings calls. He knows ticker symbols. Friends ask him which company to buy next. Daniel has nothing interesting to say. His portfolio is almost boring. No exciting stories, no dramatic wins, just another monthly purchase. One decision feels impressive, the other feels invisible. That's exactly why this comparison matters. Let's fast forward 1 year. The market has a decent year. Ryan's carefully selected portfolio returns 13%. Daniel's index fund returns 11%. Ryan immediately feels validated. His £20,000 becomes £22,600 before contributions. Including his monthly investments, his account finishes the year at roughly £32,800. Daniel's account finishes around £32,200. Ryan is ahead by about £600. On paper, that's fantastic. Sounds great, until you subtract everything else. Ryan made 38 trades during the year. Some were new purchases, others were replacements after disappointing earnings. The commissions were mostly zero. That's what the advertisements promised. But every trade still carried a bid-ask spread. Many stocks traded several pennies apart. Over dozens of transactions, those tiny spreads quietly cost around £180. Not devastating, just invisible. Then came taxes. Ryan sold 2 positions for gains after believing better opportunities had appeared. His realized gains created a tax bill. Daniel sold nothing. His taxes? Zero. Because buying and holding postpones taxation until shares are actually sold. The difference after 1 year isn't enormous. Ryan still leads, but his lead shrinks. Now move forward to year 3. Ryan has become more confident. His best stock doubled. One healthcare company gained nearly 90%. Unfortunately, 2 others fell more than 45%. Another company cut its dividend. He replaces it. His annual return averages around 8%. Daniel doesn't know which companies won. He owns all of them. His index quietly compounds at around 2% annually over the same period. Nothing spectacular, nothing terrible. His portfolio simply keeps growing. Ryan's account reaches approximately £63,400 after contributions. Daniel reaches roughly £65,100. Wait a second, Ryan picked individual winners. How did he fall behind? Because investors don't own only their winners, they own everything they bought. Every mistake counts exactly the same as every success, and every trade resets the emotional clock. Ryan spends hundreds of hours researching. Every earnings season becomes stressful. Every headline feels urgent. Daniel spends those hours with his family, or working overtime, or learning a new professional skill. Opportunity cost isn't just about money, it's also about attention. Now let's look at the behavior gap. This is where things quietly become expensive. During year 3, the market drops nearly 18% over several months. Ryan decides this time is different. Economic uncertainty feels real. He sells nearly 30% of his portfolio, planning to buy back later. He waits. The recovery begins faster than expected. He hesitates. Prices continue climbing. Eventually, he reinvests, but now at higher prices. Daniel never touches his account. His automatic investment keeps buying every month. Some purchases happen near market highs. Others happen during the decline. He doesn't know which is which, and he doesn't need to, because his strategy never depended on predicting tomorrow. Ryan believes avoiding losses protects wealth. Daniel understands something different. Missing recoveries often costs more than experiencing downturns. Let's reach year 5. Ryan's portfolio has experienced impressive highs. He's correctly identified 2 exceptional companies. One has nearly tripled. Friends constantly ask him about it. That single success dominates every conversation. Nobody asks about the 4 stocks that barely moved. Nobody remembers the company that fell 70%. That's how human memory works. We celebrate the winners. We quietly forget the losers. After 5 years, Ryan's portfolio has grown to approximately £100 and £2,000. Sounds outstanding, until you subtract everything else. Roughly £2,300 disappeared through trading spreads, market timing mistakes, and taxes triggered by frequent portfolio changes. His actual investable wealth sits closer to £99,700. Daniel's index fund has quietly reached around £108,500. He never owned the biggest winner. He also never owned only the biggest loser. Instead, he owned the market. Some companies failed. Others became giants. The winners naturally grew into larger portions of the index, while weaker businesses gradually became smaller or disappeared altogether. Without making a single decision, his portfolio constantly adapted. Ryan keeps asking one question. What stock should I buy next? Daniel keeps asking a completely different question. Did my automatic investment go through this month? Those 2 questions sound almost identical. They're not. One depends on being right over and over again. The other depends on staying invested long enough for compounding to do the heavy lifting. And by the time both men reach the halfway point of this 20-year journey, something even more important begins to happen. Because the biggest difference is no longer investment returns. It's behavior. That's the number almost nobody puts on a YouTube thumbnail. Let's move to year 10. Ryan has now spent a decade trying to outperform the market. Some years he succeeds, some years he doesn't. His average annual return before cost is approximately 1%. That's actually impressive. It's slightly higher than Daniel's index fund, which averages roughly 4% over the same period. Ryan finally has proof that active investing can work. On paper, his portfolio is worth around £208,000. Sounds fantastic. Until you subtract everything else. Over 10 years, he's realized capital gains several times after rotating into new opportunities. He's paid roughly £8,000 in cumulative taxes. Bid-ask spreads and occasional slippage have quietly consumed another £2,400. He subscribes to research platforms costing around £450 a year, adding another £4,500 over the decade. Then there's the behavioral cost. Selling during corrections and buying back after markets recovered cost him an estimated 5% per year compared with simply remaining invested. After every hidden cost is counted, Ryan's effective portfolio sits closer to pound $191,000. Daniel's story is much less dramatic. He never switched funds. He never chased hot sectors. He never sold during bear markets. His £800 monthly contribution continued regardless of headlines. His account reaches approximately £214,000. He isn't ahead because he found better companies. He's ahead because he eliminated opportunities to make expensive mistakes. That's the flip point. For years, Ryan looked smarter. He had better stories. He could explain every company he owned. Daniel couldn't even name all 500 businesses inside his fund. But wealth doesn't care who sounds smarter. Wealth only counts what remains after every cost has been paid. Now stretch the timeline to year 20. Ryan has become a genuinely skilled investor. His stock selection is still respectable. A few investments multiplied several times, several others disappointed. His gross annual return over 2 decades averages about 11%. Daniel's index fund averages approximately 10%. If all you looked at were those percentages, you'd assume Ryan wins comfortably. He doesn't. Ryan's final portfolio grows to roughly £735,000 before taxes and friction. Then reality arrives. His cumulative trading-related tax bills over 20 years total approximately £42,000. Trading spreads, slippage, and execution costs remove another £9,000. Research subscriptions total almost £10,000. Occasional emotional timing mistakes, selling after fear and buying after confidence returned, reduce his ending balance by another estimated £55,000 compared with staying fully invested. His realistic ending wealth lands around £620,000. Daniel reaches approximately £690,000, almost £70,000 more. Not because he earned dramatically higher returns, because he kept dramatically more of the returns he earned. That's what almost nobody talks about. Everyone brags about annual returns. Very few people calculate what survives after friction. Let's slow down and look at those hidden layers. First, portfolio turnover. Every time you sell one investment to buy another, there is a cost. Even if commissions are zero, spreads and price movement between placing and filling orders still exist. A portfolio turning over 60% each year quietly leaks thousands over decades. Second, taxes. Selling appreciated investments often accelerates tax payments. Money paid to the tax authority today is money that can no longer compound for another 10 or 20 years. Third, behavioral timing. According to Dalbar's long-running quantitative analysis of investor behavior, the average equity investor has historically earned less than the market itself because investors tend to buy after strong performance and sell after declines. The exact annual gap changes over different study periods, but the pattern has remained remarkably consistent. Fourth, concentration risk. Owning 12 companies feels diversified until one accounting scandal, one product failure, or one regulatory decision cuts a holding in half overnight. An index fund spreads that risk across hundreds of businesses. Fifth, research costs. Whether it's premium newsletters, screening software, charting platforms, or simply hundreds of hours spent analyzing businesses, active investing carries a real cost. Time has value, even if your broker charges nothing. Finally, overconfidence. This one never appears on a brokerage statement, but it's often the most expensive fee of all. Most investors believe they're above average. Mathematically, that can't be true. If I only showed you the downsides of individual stocks, I'd be doing exactly what many passive investing influencers do. That's not helpful either. Individual stocks absolutely have advantages. If you genuinely possess exceptional analytical skill, maintain emotional discipline, and can identify businesses whose future earnings are significantly underestimated by the market, individual stocks can outperform. History proves it. Investors like Warren Buffett built extraordinary fortunes selecting businesses. The problem is that Buffett himself has repeatedly acknowledged that most people are better served by low-cost index funds. Individual stocks also make sense in certain situations. If you work in an industry you understand deeply and can accurately evaluate competitive advantages before the broader market recognizes them, you may have an edge. If you're willing to hold exceptional companies for decades with almost no trading, taxes become much less damaging. If you're investing only a small opportunity portfolio alongside a diversified core index fund, individual stocks can satisfy your curiosity without risking your financial future. And if you inherit concentrated stock positions with favorable tax treatment, the numbers may favor holding longer rather than selling immediately. On the other side, index funds aren't perfect either. You'll never massively outperform the market. You'll own weak companies alongside great ones. During bear markets, you'll watch your portfolio decline with everyone else's. There's nowhere to hide. Index investing also requires patience. Compounding is unbelievably powerful. It's also painfully slow. For years, it feels like almost nothing is happening. Then one day the curve bends upward. That's the moment people wish they'd started earlier. Now imagine changing just one variable. Instead of investing £800 each month, Daniel increases his contribution by only £200. Nothing else changes. Over 20 years, assuming similar long-term market returns, that extra contribution alone pushes his ending wealth to roughly £855,000. Not because he discovered better investments, because he saved more consistently. That's one of the most overlooked lessons in personal finance. Small improvements in savings rate often matter more than heroic improvements in investment selection. Let's ground this in real data. According to S&P Dow Jones Indices SPIVA scorecards, the majority of actively managed U.S. equity funds have historically underperformed their benchmark indexes over long periods after fees. That's a measurable observation, not an opinion. Morningstar continues to find that expense ratios are among the strongest predictors of future fund performance because lower costs leave more returns in investors' pockets. The U.S. Internal Revenue Service treats realized capital gains as taxable events under applicable tax rules, which is exactly why unnecessary selling can reduce long-term compounding. None of those institutions are recommending a particular investment. They're simply reporting measurable data. So what's the practical strategy? Start with your foundation. Build the majority of your long-term portfolio using broadly diversified low-cost index funds. Next, automate every contribution. Remove your emotions from the process before they ever have a chance to interfere. Finally, if you truly enjoy researching businesses, limit individual stocks to a small percentage of your portfolio, an amount that won't derail your retirement if you're wrong. That gives you the excitement of investing without risking the engine that's actually building your wealth. Let's go back to Ryan and Daniel. Ryan walked away believing skill would overcome every obstacle. Daniel walked away believing consistency would eventually win. Neither one initially ran every number. Ryan underestimated the invisible costs. Daniel underestimated how difficult it would be to ignore exciting headlines for 20 straight years. In the end, neither strategy was automatically good or bad. The real difference came from what happened after the returns were earned. The real trap isn't index funds. The real trap isn't individual stocks. The real trap is making your decision based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. Because your income is different. Your taxes are different. Your risk tolerance is different. And your behavior is definitely different. The smartest investment strategy isn't the one that sounds the most impressive at dinner. It's the one you'll actually stick with for decades. And if you're wondering what happens when someone combines low-cost index funds with carefully selected individual stocks in one portfolio, that's a completely different conversation. So before you make your next investment decision, ask yourself one simple question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.